and welcome back to the ABCs of ERP and Beyond, a podcast all around enterprise resource planning and how it can support a modern day business. And straight in for today's episode, we are diving into a critical topic, especially these days for businesses that are involved in global trade. Managing tariff costs. And how do we do that in ERP? And specifically, how do we do that in Acumatica? So whether you're importing raw materials, components, finished goods, tariffs can have and are having a significant impact into costs and profitability. We'll talk about the tariffs and how they're handled in the US in particular, and how they're collected by Customs and Border Protection. Across hundreds of ports of entry in the US, and often it's the importer, not the foreign seller, who is responsible for paying them, dependent obviously on your Incoterms of your contract. So we'll break down some of the ways that global trade work so we can understand better how tariffs are paid, and then we'll move on to a quick demo in Acumatica to see how you can better monitor them, manage them, and really see your true landed cost with these duties involved as well. So I cannot do this without my fellow co-host, Nirav Shah. Welcome back.
Hello, Peter. Welcome. I'm happy to be back here again, and talking about this topic that's been really a hot topic, right? Since middle of last year. Imposing tariffs and how to control bringing back, manufacturing or distribution back to the United States. I talk to customers all the time, and this is a very, I guess, a little bit confusing and scary time, especially if your business relies on heavily importing goods from, China or Canada or Mexico, or these different places where the current administration has put in, these really high tariffs to import those products in, and it has detrimental effects, right? Good or bad, right? And this is not a podcast to kind of, find out what side of the aisle you're on. I think it's more or less is that these are here, and how do we manage it, right? What are they? Number one, right? Maybe just a quick recap. How does this work from a tariff perspective? And then how do you manage if you're using Acumatica, or you are in the process of evaluating Acumatica and you're impacted by tariffs? Well, how do you properly record the tariff in your Acumatica system? How could you differentiate between the standard tariff and the new Trump Code 99, right, tariff that's out there now for these various different countries, China, Canada, Mexico? How do you manage that, and how do you get that type of reporting, granular level of reporting, to see the standard tariff between the standard tariff and the Trump tariff, right? But let's start with, I think, Peter, just for our audience, right, tariffs, right? It may not impact you, and you're just interested in just understand what tariffs are, and see how you'd have to kind of go through this process, or you do know it. But just to recap, tariffs are typically charged as a percentage of the price a buyer pays a foreign seller, right? In the United States, tariffs are collected by Customs and Border Protection agents at all 328 ports of entry across the country, right? And essentially what that is goods will come in from the seller, come into the port, and there is a commercial invoice associated with that goods. And at the point of entry, Customs and Border Protection agents will look up what they call this HTS, Harmonized Tariff Schedule. We'll get into kind of a little bit more about that here just soon, but they'll look up what type of product is in this container or shipment, and then follow that schedule to calculate what percentage of tariff charges should be added and charged back to the buyer. Right?
Yep. That's basically it. Yep.
Mm-hmm. Yeah, and American companies get charged with this, and they have to pay the tariff for doing business with these international companies, essentially.
Yeah,
And I know, Peter, you deal with tariffs often in your day to day, and understand tariffs pretty well.
yeah,
Anything there from
yeah.
the tariff standpoint that is of additional importance to understand?
Yeah, I guess my background in sales, we used to do, well, the company still does a lot of international shipments. So unless any kind of international shipment or export import relationship where there's not a free trade agreement already in place. So, for example, the EU has free trade within all EU countries, so there's no duties there. The UK have one long-term one with Canada, for example. But anything else, any kind of international piece of business, when you're selling products, typically will have a duty. And as you said, it's a percentage. And they are based on the HTS system, which is a global, well, including the title, it's harmonized system that has all of the products ever. Any product will have a long code which denotes exactly what it is. Everything from sheet metal, machinery, construction machinery, ovens, um, bathtubs, rubber ducks, you name it, it will have a particular code. And that code, the longer the code gets, the more specific it gets. And then that is used to denote what the duty would be if it's going from one country to another. So essentially, what Customs and Border Protection in the US would do is they would see an import come in, and it's a container full of rubber ducks, for example. The commercial invoice that accompanies that shipment will need on it the value of the shipment, the value of the goods. Say it's $1,000. It will need the HTS code, and it will need the origin country of origin where it's come from, and it will also need what we say is the Incoterms. So there's a few things they need, but essentially what they're going to do is they're first of all going to look up the HTS code to find out what the duty is. Say, for example, it's 10% on rubber ducks. They will then have a look at the country of origin, because if it's coming from a country where there's a free trade agreement, then there won't be any duty to pay. Whereas if it's coming from China, there might be 50% to pay, and it will be 50% or whatever the percentage is of the value of that that's shown on the commercial invoice. Now, that's essentially denotes or works out what the duty is to be paid. So if it's $1,000 and it's 50%, someone needs to pay Customs and Border Protection $500 to be able to clear customs, so we can actually go for final delivery. Someone needs to pay that. Otherwise, it's not leaving the port. So someone needs to pay the $500. Now, who needs to pay that? And this is where we can kind of get there's a bit of contention about especially around these Trump tariffs, as they're called.
Yeah.
Is it just a revenue generator? Well, it kind of depends on the Incoterms. So again, the Incoterms, they are a globally recognized system that specifies with the shipment who does what, who is responsible for what. And that's everything. That's down to who is responsible for driving it and putting it on the boat in the first place. Who's now responsible for replacing those goods if the container falls off the side of the ship in the Atlantic Ocean? And it also includes who is going to be paying any applicable import duties. So dependent on the Incoterms, depends on who Customs and Border Protection will contact from the commercial invoice who needs to settle the bill. So, for example, if it's XWorks or FOB or CFR, any of these, it's the importer of record. Whoever is named as the importer will be the one that gets contacted that needs to settle up the duty payment. If it's DDP, there's very few where it's actually on the seller to pay. So DDP is one, but the vast majority, it's down to the buyer to actually pay this. So, yeah, without treading lightly around this topic. It's not really a revenue generator because it's often the buyer.
Right.
It's often the person. It's the US company. If our scenario is we're buying something from China, it's the US company that needs to pay the US customs service. So
Yeah.
is it really generating revenue for the US? Well,
Yeah. Yeah.
so that's kind of in a nutshell a quick explainer on these duties and what's involved in calculating the duty to be paid there.
Yeah, I think very well explained from the standpoint of where it starts, how it begins, and then how that cost keeps kind of, as it's switching hands, right, continues to add additional cost until we get to the U.S. and then
Yeah.
you need to have the right kind of the INCO terms or the agreement. Who's going to end up
Yeah.
paying this? And right now,
Yeah.
99%, or I want to say 98%, it's all the importer, right? And there's specific reasons why that's put in place.
Well,
mainly to
100%. It's always the importer, but it depends on
Right.
who is named as the importer on the commercial invoice.
Right.
So
Right.
the buyer could be the importer. Most of the time they are. The seller could be the importer. So if I'm selling at DDP, DDP Incoterm says that I'm responsible all the way to delivering it to your front door, which includes export documentation, which includes buying the space on the boat. It includes taking it off the boat. It includes the price of the duty, paying the duty. It then includes the road freight from the port to your front door. So DDP, I'm everything. I'm the exporter, I'm the importer, I'm the lot. So 100% of the time, it's the importer. It just depends on who is acting as the importer.
Right.
Which reminds me of a good point there. Who do you pay? So someone needs to pay Customs and Border Protection in the US. A lot of companies now are having to pay duty that never paid duty before.
Right.
So this is why this is a great topic to do this, and how does an ERP kind of handle this. But the other side is, who do you phone up to pay US Customs and Border? There's no kind of way to do that that's easy to find out. So there are companies that you can use, and they're called customs brokers that are experienced in handling imports and exports. So you might actually work with a broker, and they will clear customs for you. And what that means is they will be paying the duties in order to get it through customs and out of the port. Because if these ports do not like delays in ports, they have hundreds of boats lining up trying to come in.
Exactly.
Yeah, and they want to move goods. So there's a thing called demurrage charges. If it sits at the port in the dock for too long, it could be $1,000 a day per pallet. They will charge what they like. So often companies that aren't experienced with this will use the services of a customs broker who will just pay it immediately, get it off there. Let's put it in a bonded warehouse or a warehouse close by, and then the broker can then invoice you as the buyer and settle up that. So the customs broker will pay the duties for you on your behalf. They'll be the named importer. They will handle that, and then obviously they will recoup plus a little bit for their services of clearing it
for the services.
So that's kind of where we're at with duties. And of course, this is a real hot topic because the US typically have had great trade relationships with most of the world. Anyway, I know you do for the UK, Canada and Mexico, most of EU as well. So it never really was a thing. As much as the import customs clearance still takes place, it always has done. It was always needed a commercial invoice. People didn't really know what happens. So now you've got all of these shipments that are suddenly requiring payment. How do you handle those? So that's kind of where we want to get to through this episode.
Yeah, and that has a trickling effect, right? So you paid customs, you paid your broker, and you have all these costs, right? And now the question is how am I accounting for this? Am I actually making money on selling my goods to my customer, right?
Yeah. This is the
Where
thing,
did
because
my margin go?
you're still you're still buying the product for the same price. So if we go back to our container of rubber ducks, and each rubber duck was $1, I'm still buying them from my vendor for $1. But my cost is not $1 if I'm getting
No,
charged load of duty.
yeah, exactly. And how do you want to handle that cost, right? Um, Most companies, they may just say, hey, I want it to be part of my unit cost. So if I'm losing money, if my margin is negative, my margin is lower, I want to know that in my gross margin, my profitability, right? Or P&L statement. Or I want to be able to run different type of analytics around this particular tariff that I'm being charged for, right? What impact is it having on my business, right? And I think that's the key question is how do you collect that information and put it into the right bucket in your financials or your margin so you could determine, do you need to increase your prices, right? That's a typical hard sell, right? To increase prices just because of tariffs, right? You may lose customers pretty quickly that way, but it's a hard conversation. But if you don't know what your margin is after the tariffs, right, or these additional charges that are coming in, it's going to put you in a bad spot. That's a big blind spot in your business, in my opinion. And
Yeah.
and that's what ERP does, right? ERP is designed to help you minimize the gap and the number of blind spots you have, right? So whether if it's tariffs being thrown at you right now, right, that's in the current economic environment, it could be a different type of, when oil prices were really high, if you remember, right, and all these logistics companies were charging, oil surcharges, gas surcharges, right, all these other things. Well, how do you handle that? How could you go ahead and analyze what is the makeup of my unit cost? So
Yeah.
you have pure cost of item that you're buying from your vendor, as you mentioned, Peter, right? And then you have the tariff, right? The existing tariff, right? Which was the minimum 5%, 3.5%, 3.4%. But then now you got the Trump tariff, which is additional 25%, right? In some categories, right? And then what happens if you get oil surcharges added on top? Right, the economic environment's pretty hostile right now, right? Like a lot of people are kind of worried with all these costs coming in. Well, the smarter businesses, right, are able to organize this cost and see it very quickly and make determinations on they should go buy from to lower their costs, right? Whether that is continuing buying from China, continuing buying from Canada, or do they now have enough data in their current system where they could run a report and say, hey, we just spent $300,000 in tariffs the last month. This is really bleeding us. Our unit costs are being are being heavily skewed now. We have lower margins. Let's go ahead and outsource and find other vendors, maybe locally, that we could buy the same product from. Right now, that's a whole different conversation that could take you into this area of quality and what's going to happen with supply and demand. We talked about that a little bit earlier before we jumped on today, Peter. Right? We said, well, if there's going to be higher demand out there, but there's not enough supply for even these suppliers on shore, so you don't have to go overseas and incur those tariff costs. Well, now that demand, because it's increased, you're going to pay more for it here locally, right? So there's it's a double-edged sword all over the place, in my opinion. But you have to make those decisions as you embark on
everyone
this.
suffers. Everyone suffers under a trade war like this. Yeah, you certainly want to be able to track this because you want to be able to compare that. Otherwise, you have no way of knowing. This isn't a game you can win. I think winning the game is by losing the least. And you need to be able to track this, right?
You have to be able to track it. Yeah, absolutely. And that's what we want to show today, right? And we want to show how this is trackable very easily through Acumatica, right? How you could track this additional Trump tariff that's out there inside Acumatica. So you could delineate between the standard tariff and the Trump tariff, right? Very easily through the system. So with that being said, let's jump into Acumatica and let's go through an example, right? Show customers or prospect that who are interested in use Acumatica or they're currently using Acumatica how to set this up. So the first piece of this is we're going to show us a little bit of setup. Then we'll go ahead and create a real life example where we go ahead and buy steel, let's say, for example, from China, a vendor from China, and we get the AP invoice, we process the invoice, and then we get a bill from the U.S. Customs and Patrol, Border Protection Agency, on the tariff charge, which could be itemized. It could be your standard 3.4%. Then maybe we have a 5%, and then we have a 25% Trump charge, right? How do we itemize that? On the landed cost side of it, associating it back to the receipt, and then what we'll do is run a few inquiries to look at that landed cost and be able to properly identify which charges got charged against that receipt and the inventory valuation of that item.
Yep.
Right? And a lot of customers, not a lot of customers, I think some people may say, well, you know what, I don't want to capitalize my tariff charges. I just wanted to go and expense it. That's totally fine. You could do that as well, right? Just take the AP invoice and do a GL distribution to like a tariff GL account. However, that really doesn't show your true operational margin when it comes to what it actually took to sell the goods, to buy them, transport them, warehouse it, and ship it out the door to the customer. So if you're interested in that real-time reporting, real-time analysis from a profit loss perspective, you should probably capitalize it and bring it up to your P&L, which is industry practice, best industry practice, versus if you don't do much of it and a lot of your stuff is not tariffed, then maybe consider just doing a simple AP invoice and doing a GL distribution. But today we're going to be talking about the landed cost side of it.
Yep. Let's go.
So let's go for it. We'll look at Acumatica. We have Acumatica up here on another screen. We're going to go ahead and now talk a little bit about the setup inside Acumatica when it comes to tariff. We're going to go into our vendor first. So I could go into purchases, I go into vendor, and I'll look at steel, one of our steel vendors. We have KDM Steel. I'm going to go into this KDM Steel vendor. This is the vendor we're going to buy from. We're going to buy some rolls of sheet metal, or each is sheet metal actually. And this vendor name is Sheet Metal Fabrication China. You notice we have the China address on here, but nothing else we have to do here on the vendor card when we're dealing with vendors and where we buy from. It's just standard setup here. There's really nothing unique here. Now, what is unique, however, is if I go back to our vendor and I go to U.S. Custom, that's another vendor. We need to make sure we create our U.S. Customs and Border Protection as a vendor because we receive the POs from there. Peter, you referred to if you're using a broker, then you don't have to create them as a vendor. Okay, so a little difference in setup there. But if you're not using a broker and you are getting the tariff invoice directly from the U.S. Customs and Protection, Border Protection, then you'd have to create them as a vendor in Acumatica. And the real difference here between a standard vendor and this type of landed cost vendor is that there's a flag called landed cost vendor, and we need to make sure this is selected. Okay, if it's not selected, you're not going to be able to select this vendor on the landed cost side. So really important point here, make sure you select landed cost vendor. Now, we're going to go ahead and create a purchase order of a sheet of steel, okay? And we'll do 60 eaches at a certain price. We'll receiving the invoice, and then we'll start the landed cost side of it and how that works. And actually, Peter, before I do that, just for our audience, just so they see the landed cost setup part of it, I'm going to go to search landed cost here, and we have different types of landed costs that Acumatica could support. Not just tariffs. So if we go to landed cost codes, here in our setup, we have customs, miscellaneous, tariffs, transport, and I've created a new code called Trump Code 99. Okay, so what this does for us, it separates the Trump-specific tariff of 25%, right, from the standard tariff. 5%, 3%, whatever that looks like, right? So now you can run an analysis on your landed cost, and how much more am I paying because of this Trump tariff, right? And determine, well, okay, over time, how much have I paid, and do we have to maybe go to a different vendor, right? Just keeps the data more organized that way. You get more meaningful, better conversations within your accounting team and your purchasing team to make better decisions for your company.
And a lot of companies want to be able to do this as well, because if you go on the United States International Trade Commission site, they have an HTS code lookup database. So you just plug in the HTS code.
Yeah.
It will give you a description of it. So, for example, sheet metal will be like sheet metal, primarily of steel, of 10 millimeter thickness. You know, they're very, very specific to the product. And then it will give you a percentage. So at the moment, when you go on there and you put an HTS code for 10 millimeter thick steel sheet metal, it will say, in fact, it says free. It says there's no duty. But next to it is a nice little asterisk, and you click on that, and there's an additional duty applied, which is a new HTS code, and it's like 9901-88-01. And the clause on there says, if it's of goods of origin China, additional 25%. So companies want to be able to show that and say, well, normally this was our cost, but now I guess it's a little bit like surcharges. It's kind of temporary. We don't know when it's going to finish, but we don't want to permanently. We don't want to see this as a permanent thing and just bucket it all into one duty thing. So customers want to say, well, you know, this particular product is normally 3.4% duty, but it's 3.4 plus 25%.
25%.
Want to be able to slice and dice their data by being able to separate those two charges out.
Yeah, absolutely. Absolutely. Some really good points there. And the benefit here of you using the Acumatica landed cost module is it lets you do that, right? You just don't have to dump everything into tariffs, quote unquote tariffs, and then try to figure out through combing through manual invoices, well, how much tariff was standard versus a Trump tariff, right? You could create those unique codes in a granular level and then assign them when you go ahead and create this landed cost charge against that PO receipt. Okay, so here we have a unique landed cost code that we created here called Trump Code 99. Okay, and the different types of landed costs here, just real quickly, spend just not too long, but a quick 5 seconds here. We have freight miscellaneous origin charges, custom duties, VAT taxes, miscellaneous destination charges, and other. These are just hard coded. You can't change these, but you know, just depends on the type of landed cost code you create. You just want to make sure you put it in the correct bucket, essentially. Right. Now, continuing through our example here, now we saw how our landed costs are set up and categorized. We're going to go and create our PO. So I'm going to select purchase orders. I'm going to create a new PO here. Okay, and the PO I'm going to create is KDM Steel. I'm buying it from China. Okay, and I'm going to create a new item. Now to create a new item, I'm going to select an existing item. I'm going to select my item is called a sheet of steel. Right here, keeping it easy. We're gonna order 60 of these guys, right? So we're gonna order 60 at $1,500 each. Each sheet is $1,500. So we're looking at a PO cost to the vendor of $90,000. Okay, this is just pure PO cost that we're buying from the seller, right? For this sheet of steel. So I'm gonna go ahead and remove this from hold. Okay, this is standard Acumatica, really no difference on the PO side. You're going to go and release it, you're going to receive it, right? So on and so forth. Then you're going to get the AP bill. I'm going to approve this. This is kind of going through an approval process. I'm going to select my PO receipt. Okay, I don't have to do the PO receipt from the PO. There's also a standalone function to do my PO receipt. But I just did it directly from the PO as well, just depending on the size of your organization. So I'm in my PO receipts. I'm going to receive all 60. Right, I'm going to create my vendor bill as well. Maybe the seller has sent me the bill as well. So I'm just going to put here something XRP. Just put some sort of reference number here. I'm going to release this. Now I'm going to receive this in, essentially. I'm going to get 60 on hand at $1,500 a piece. right? So if I go to this inventory ID, okay, I go into inventory ID, and I could go into our price and cost. See, my average cost right now is $1,500 each that we received in. I go to inventory transaction, and I'll look at, maximize this a little bit. I'll look at this, my unit cost is $1,500. Now, the next step here is going to be landed cost. But before I do that, I'm just going to flag this. There's an include landed cost and unit cost option. You notice my price unit cost does not change. It's still $1,500 because I haven't associated any landed cost to my receipt yet. That's going to change. I'm going to close this out of here. I'm going to close my stock item. And now I'm going to go back to purchases, and I am going to simulate I just received my U.S. Customs bill for my tariffs that I need to essentially pay to release the goods so I get my final shipment. Now, I'm going to come through here. I'm going to say my vendor is going to be U.S. Customs. And you notice, remember I said earlier, if you don't flag that vendor as a landed cost vendor on the vendor master, you're not going to see that vendor to be selected here when you're creating the landed cost. So that's an important step early on that I mentioned. So make sure you select that, this is a landed cost vendor on the vendor setup in order for you to select it. So I'm going to select U.S. Customs in our case here. I'll create the bill as well because I did get the bill from us. We'll say, let's say OP. Just put some information in here. That's the bill we're going to create. Our landed cost code. So you remember in our example, we want to have a clear separation between the original tariff of 5% and the Trump tariff of 25%. Okay, and how do we do that in Acumatica? Is when we create our landed cost record, we could go and first select our initial tariff of 5%, okay? And I could put in here, let's say that's going to be 5%, that's going to be $4,500. Remember, we're doing this on, against $90,000, what that PO was. Obviously, I would have that landed cost invoice in front of me, all right? And now we add another line. My second line is going to be my Trump tariff, which here is going to be $22,500, right? So my total invoice that I received from U.S. Customs is for $27,000, but that's broken up by the initial 5%, and then I got the Trump tariff of 25%. So I want to create a fine distinction between what I'm paying in tariff by the type of tariff that I'm paying here. Okay. Now, the next step is once I've added my landed cost, is go to my details tab and select my PO receipt. Now, remember my PO receipt, it's going to be my receipt here, KDM steel of 60 pieces. I'm going to add and close. So it also assigned the PO receipt number directly to my landed cost record. I'm going to go ahead and at this point, if everything looks good, I can just go ahead and remove from hold, and then I'll release. Now, once I release it, what the system is doing is creating the AP invoice for this U.S. Customs, but then also taking the landed cost value of $27,000 and booking it back up to inventory by way of amortizing it against the quantities that were received in against the original PO. And how do we verify this, right? After we go ahead and update the landed cost, I'm going to go into my inventory ID of sheet metal. Okay. I'm going to look at my price and cost, and you'll notice my average cost now is $19.50. It's added landed cost to it per piece. So I have 60 on hand at $19.50, but how do I know the details of that? The details of that is by going into the inventory and transaction history table. I'm going to open this up, and you notice that I have two adjustment lines under the receipt. One is going to be for our 5% tariff, and the second is going to be for our Trump tariff that we have in here for $22,500, but they all roll up into our unit cost. So if I now flag include landed cost and unit cost, you see my unit cost amount has now changed. It's $19.50. And how do I know that this journalized correctly at the end of the day, right? We could kind of go through the history of this. If I go into our first 5% adjustment, it'll take us to our adjustment here, which is our landed cost adjustment we know here. And if I look at the financials, it'll basically show me it took the accrual, credited $4,500, and then it debited inventory of $4,500. So I know that $4,500 went up to this inventory item. Okay. And now if I close this and I go into my second line, which is my Trump tariff, right? My reason code is Trump code 99 in this case. And if I go to financials and I look at this, I'll see this 22,500, which is my Trump tariff, booked backed up to my balance sheet as inventory asset against the same item, sheet metal. Okay. So now you see how I have that separation of data. Makes it really easy for me to do my analysis. And if I continue with my analysis of this particular transaction, if I run my inventory valuation report, and let's say I just search for sheet, okay, sheet of metal, and I'm going to do detail because I want to know what my detail, my inventory valuation is. If I look at this, I have a cost now of $117,000 in inventory against 60 pieces on hand, and that's broken out by $90,000 of receipt cost, and here are my adjustments of my various tariffs that I have, which equals my $117,000. So we could really easily see now, because the data is already, categorized, and we saw that during some of the financial entries, we have the Trump code versus the standard tariff. We could easily bring some of those columns in here. So if you wanted to know that this adjustment was a Trump code adjustment versus a tariff adjustment, and you need that analysis on your reports, because that data is already organized in the database, we could easily bring those fields into this inventory valuation report.
Yep.
So that's the quick and easy way to handle these additional tariff charges inside Acumatica, and not only tariffs, but other different types of landed costs. As the economic, environment changes, and we were talking about this, oil prices went up like crazy, a while ago, and we needed to add that surcharge as a unique landed cost against our items. Well, use the landed cost functionality in Acumatica, correctly. If something happens where you have a special tax that you have to pay, maybe, and you want to kind of understand that, well, create that as a landed cost eventually, right? Landed cost is not a set it and forget it type of situation. You should always evaluate, well, is this something, a new condition or new situation that's occur in my industry or the economy that you work in, that you operate in, that you want to further analyze so you could maybe become better price competitive and find better vendors, or domestic vendors versus international vendors, so on and so forth, to keep managing your margins correctly at the end of the day, instead of just throwing everything to expense. So using landed cost effectively, I think, is a critical business functionality to do this and have landed costs be organized correctly. Like an ERP system like Acumatica handles that pretty well.
Yeah, and this is really important because this really is your true cost. This is not just the item cost. That's not the finish line, is it?
Right.
And it's really important for quotation building for maybe your external sales team. They may be thinking that they're hitting maybe they have to hit a certain profit margin. Maybe they're not actually hitting it. Maybe they think they are, if they aren't seeing the true landed cost of the item that they're selling. So you might find that you're underperforming, you're losing profitability by paying all of these tariffs that should be built into the overall cost of the item in the first place.
Absolutely.
Good. It's great to be able to show landed costs, and it's really nice that we can kind of set up multiple and assign it to a purchase receipt, so we know exactly where it's being applied, how it's being spread over, the quantity on the purchase receipt, and then in the background it's handling all of that and then giving us that average cost. And as we said, the ability to then report on that and say, of this particular type of tariff or particular type of duty that we're paying. Maybe it's hitting certain product lines, maybe it's hitting certain finished goods, especially if you're doing this on raw materials like sheet metal. If you're bringing that in as raw material, and it's then going into on a particular bill of materials to a finished good, you want all of that to roll up to you so you can actually see your finest, your finished kind of good cost.
Exactly.
Before you decide on what price point to sell those at.
Yeah, and when you have your tariffs and you're able to properly categorize them and properly try to, record them in your system, you could do a year-end analysis, right? And say, hey, year-end, we need to update our prices, but what are we paying extra? That contribute directly to the transportation, to the value or the fulfillment of us bringing the product here into the customer. What are these extra costs? Now, let's look at that. All these extra costs, let's build these in so we have a better margin at the end of the day. Or let's negotiate with our vendors and why they're charging us this and how we could reduce the cost, right? If you could actually make the decisions to move your business, to higher profitability with a more structured, right, way to see the data in like a system like the Acumatica instead of using Excel spreadsheets and all these other things that companies use to think that they're managing it correctly, but it becomes a lot of formatting issues and missing data than being helpful at the end of the day. But if you create a process around this, like an ERP system has, I think that'll help you make better decisions in these areas, in the future.
Yeah, it's just another thing that is best belonging in an ERP and out of someone's spreadsheet sitting on their desktop. It's just another thing to put into the heart of the business. We say that
exactly.
when we're going through migrations, it's a heart transplant, and this is another thing that belongs in that. It belongs in your central kind of single source of truth, and it's great we have the functionality to be able to include that in there.
Yeah.
Good. Well, I think that pretty much wraps up today's episode, around managing tariff costs and how to manage those in Acumatica. So it's great to cover everything from what are tariffs, how they're applied, role of Incoterms, the role of the importer, maybe demystifying some of this. That's not just a revenue generator. All the way down to recording tariffs as landed costs in Acumatica to really keep your financials accurate and keep you, I guess, protecting your margins. We could say essentially it's protecting your margins and also avoiding compliance headaches as well when you go to report on this. To be able to just pull that straight from Acumatica and know it's to the cent accurate is going to be hugely beneficial. Come audit time or come financial submission time. So yes, thank you very much for another great demo there, Nirav. I always like these. I get to sit back and eat popcorn and drink beer as you work away.
You're kind of the tariff expert today, so I learned a ton, and this has been really good because I'm sure this has been on the minds of a lot of companies. So hopefully we're able to, like you said, demystify and clarify, how this works and how they could get a better grip of it at the end of the day. We can't guarantee that we're going to help you save money on tariffs, but we'll help you how we could better manage tariffs and evaluate the tariffs that you're getting charged for.
Yep. Yeah, this is definitely one of those games where you win by losing at least.
Yeah, I know.
So, and you can only really get there through data-driven decisions. And
exactly.
If you're not capturing the right data, then you don't really stand a chance.
You don't.
So if you want more of this content, make sure that you subscribe to the ABCs of ERP and Beyond. We come out with a new episode every 2 weeks. We shoot it record it, and publish it straight onto YouTube and all the major podcast platforms: Spotify, Apple Podcasts, Pocket Casts, Podbean. I got another one in there. No, I'm trying to create the list longer each time.
Last week when we shot.
No, it's just 3. Yeah, 3 until I run out. So I'm up to 4.
Okay.
So find us, but yeah, definitely reach out to us on YouTube. So if you are just listening to this, some of it may have made sense, but the demo probably wouldn't if you're not seeing what we're
Yeah.
doing. So make sure you
Yeah.
search for us there. Also search for us on LinkedIn. You'll find our LinkedIn page. We post on there. So feel free to find us, leave us a review. It really helps us keep the content valuable and kind of steers us into the direction of where you want us to go. So you can also reach out to us if you do have any questions or topics that you want to cover in future episodes, or if you've got any other questions of what you might have seen today. And with that, Nirav, where can people reach you?
Yeah, through LinkedIn, I think it's great. I'm always responding to questions through LinkedIn or my website. My email address, nirav.shah@seriousrp.com. So, we want to educate and help people understand how ERP can help benefit your business at the end of the day, and keep driving future innovation and revenue profits ultimately. So we feel strongly that ERP systems could do that. There's a lot of different aspects that revolve around ERP, and that's what we try to capture here. So hopefully you find the content very, very valuable.
Great. And until next time, have a wonderful 2 weeks, and I'll catch you on the next episode.